In this video, Michael Saylor, after 3 consecutive losing quarters, announced that he is now ready to sell his bitcoins. Bitcoin option prices are at their lowest, with volatility being given away almost for free. And as usual, an analysis of the weekly option strategy. Hello friends, this is the Optionomics channel, and I'm your host Roman Besedovsky. And today, as usual, we'll be looking at what opportunities there are to make money with Bitcoin options. And accordingly, the most important news right now is that the biggest Bitcoin holder we know of at the moment is Michael Saylor and his company, Strategy. If you remember just 2 or 3 months ago, he said he would never sell his Bitcoins. Even if it drops by 90%, he would refinance and buy more. Now, accordingly, after he had 3 consecutive losing quarters, he said that in principle it's possible to sell some of the Bitcoins. And this actually changes the whole paradigm, because in reality, this growth that happened from almost 70 to 82 was almost entirely fueled by Saylor's money. That is, Saylor was issuing his preferred shares and accordingly using that money to buy Bitcoin. If he now starts selling something, it could actually push the market down quite significantly. And look, here's what else I see at the moment on the weekly chart. It turns out we've been growing, if you don't count this week when overall Bitcoin just stood still. That makes it 1, 2, 3, 4, 5, 6 weeks in a row, and we're approaching the first moving average on the weekly chart. Right now, the moving averages are pointing downward, and in my experience, if we look at the previous trend when it was rising, you can see that the moving average at this point and here as well basically acted as support for some time. And it often happens that when the market changes trend, that is, the moving averages, while they were pointing upward, they acted as support. Now the moving averages are pointing downward. And that's why I believe that the market could reverse from these moving averages and show a pretty decent correction. The only thing is there's still some distance to them. In other words, they're somewhere around 87 to 88. So technically, basically, I think Bitcoin could still easily reach 90. It would be good if this happened in a single candle and then there would be a reversal. But since things can happen in all sorts of ways, and they do happen in fact, sometimes the market reverses before reaching the support or resistance line, so maybe it will turn around a bit earlier this time as well. And look, as usual, let's follow our traditional scenario and first analyze the previous trade. Let me remind you that last time I opened 8 old call options at 74 and put options as well. If you remember, I increased the risk, and accordingly I opened a bit more than usual, and here's what happened. I opened 4.5 contracts each of the 74 puts and the 82 calls. You see here it says 3.15. Why is that? Because I partially locked in profits. And why? I locked in profits at the moment when the market shot above the 82 strike. Basically, my positions were set quite close by. Take profit, that is, I set a take profit at $2,000 each. But at one point, the options reached about $1,400, I think, for a day. I remember what they cost. And accordingly, then the market started to pull back. So when it first pulled back on Wednesday, then tried to rise to 82 again the next day and pulled back again, I realized there was a chance I might end up with nothing at all. In the end, I might not lock in any profits. That's why I decided to partially close my profits so that the potential risk would be lower. And since I was still taking on increased risk, this helped me avoid losses. 2%. So accordingly, that's $470. I locked that in. And on the remaining options, I ended up with a standard loss about minus $1,000. So roughly minus 1%. And accordingly, overall I'm satisfied, because in the end I didn't lose those 2% that I had initially planned for. And actually, when you carefully increase your risk, in principle, this additional risk can be used to partially lock in profits and accordingly reduce the overall risk of the initial position. And look, there's another point. Since volatility is very low right now, basically the market, it quite easily reaches the boundaries. That is, for example, here we only needed Bitcoin to move just 6% for the market to go beyond the strike, and that's exactly what happened. I opened the position when the market was around 78,500, and then it moved up to 82,800. If we look at the weekly chart, at the weekly table that I keep, you can see here that at its peak it moved 5.3%, so almost 6. In fact, it fell a little short, so even at that moment it allowed me to lock in some profit. But since I was still counting on a more significant move, I only closed the position when I realized that it probably wouldn't go any further. That's it. And look what happens next. It turns out that this has been going on for several weeks in a row now. So here we have a week with a small movement. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 13 weeks where the market hasn't even moved 8% before closing. And if I remember correctly, I mentioned this in the previous video, if we look at the 8% mark, the maximum number of weeks the market didn't move 8% before closing was 15 weeks. And if we look at the wicks, the maximum was 11 weeks. And now I think if we count the wick, how much have we moved? 5.3%. So basically, if we look, oh, by the way, there was 1 week here with an 8% move. That was at the beginning of April. So if we set it to 9, then basically it turns out to be 13 weeks. Here, we're already close to that value. It turns out that the last time there was a 10% move, it was for 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row. The maximum period without a 9% move was 13 weeks. And generally speaking, from everything I see right now, the market is getting narrower and narrower, and option prices are getting cheaper and cheaper. That is, if you look at the chart on the Velo website and zoom out a bit, you can see that option prices have already dropped below these very minimums. So if we hover the mouse here, basically, these minimums, which were around the end of January 2026, are the minimums that are lower than the volatility that followed, it turns out, that Friday when there was a massive liquidation on Binance and accordingly on other exchanges as well. And it turns out that at the moment, volatility is very cheap. That is, for example, if we look at the SOC, the central arrow is currently set. So for example, if we take the closest options, for instance, at the moment, the market is at 8,500, but basically we can just take the 8,500 for May 15th. Okay. Here you can see it's priced at $1,300, and accordingly, for example, the 8,500 put, it's priced at $1,400. So in total, the two central options cost $2,700. This means that if by the end of the week, which is marked here by the green line, the market moves by 2,700. That is, it will be either above 8,800 or below, respectively. Downward, that gives us about 7,750, roughly 7,700, 8,500, 8,200, a bit higher. Notice how narrow the range is. So if you just take, for example, the central options, the probability that the price won't even leave this corridor is clearly very low. And especially if you extend the charts a bit and look at what the volatility was like before, you can see that right now everything is trading in a very tight range. And that's why, in my opinion, right now is one of those rare opportunities when options are priced quite cheaply. Not just quite, but extremely cheaply. So it turns out that almost any movement, one way or another, could make these options profitable. And in principle, looking at last week, it was clear that yes, I could have locked in a 4 times return, and the market even moved beyond 5 strike levels. I was just a bit greedy. But, as I mentioned earlier, if we're buying options for a strong move, then there's no point in locking in a weaker move because it doesn't make up for previous losses. So, accordingly, what is my forecast for this week? It turns out that I expect if the market moves up to the averages, it could go somewhere around, if we look at the weekly chart, somewhere around roughly 87 to 88. But if the market turns around now and goes down, then I think it will go down. It could form a pretty strong candle. Why? Because declines usually happen much faster. If this news about Saylor somehow has an effect, and not just an effect, but he actually starts selling something, then we could very well reach lower levels. Somewhere around, well, 69 is possible, of course, but I think 71 or 72 is quite realistic. But in reality, it all depends on the market. That is, if some other geopolitical events come into play, things could move even faster. So it turns out that I need to buy options if I'm counting on these boundaries, somewhere within these limits, and accordingly, somewhere around 84 to 85, and also somewhere around 75 to 76. Let's also take a look at the other indicators to see what's happening right now. So it turns out that on the CoinGlass website, and what about open interest? So if we look at Bitcoin's open interest, we can see that over the past week, it has generally increased. And in principle, it has grown quite significantly. On May 9th, there were 430 Bitcoins open, and now we have 463, which is about 24,000 Bitcoins. Someone opened these in options. Let's take a look at the open interest chart. Accordingly, the largest position is still for June. By the way, there's also a fairly large one for May. And then accordingly for September, and it turns out for December as well. Let's start with May. What do we have at the end of May? So, May 29th. Yes. Notice, interestingly, that a pretty thick bar has appeared at the 80,000 level. So basically, this suggests that many of those opening positions for May expect that it might not go above 80,000. Therefore, this bar actually reduces the likelihood that we'll go up to around 90. Although I still don't want to take options in only one direction. And accordingly, I will still take some to the upside in case this bar doesn't work out. By the way, it's quite possible that, for example, since today is still not May 29th, there could be a spike at some point up to around 88 to 89, and then, for instance, the market could sharply drop back below 80. So basically, we still have 2 weeks. Therefore, such a scenario is quite possible. So resistance is at 80 on the upside, and on the downside, well, there's practically none. That is, basically, yes, there's some small support. There's 74, there's 70, but overall, by the way, there's not much here. If we look at June, it turns out that there's also some at 80, but the main one here is at 90. So overall, there's more resistance at 90 here, but there are also local levels at 85, 80. Wait, I got confused. By the way, pay attention, someone, apparently a central player, might have been selling straddles. So puts appeared at 80, but overall the biggest support is still at 60. So it turns out that right here, the 70 to 80 corridor, it seems like it has a chance for some sideways trading, but in principle, we could go up to 90 if we look at the remaining positions. So for September to September, actually, the biggest support is at 100,000 up here. So basically, the way down is open. Accordingly, pay attention, someone at 75, these are interesting. It's not very clear what's going on there. Maybe there was a buying flow here, or a selling one. In general, you can expect that by September, Bitcoin will be above 75. So let's move on. We still have December left. Well, as for December, yes, there's this really big spike at 120, but that's still quite far off. And here it turns out the corridor is marked between 80 and 60. By the way, it's interesting that for December, there are quite a lot of open 80 calls. Honestly, I can't remember right now whether this spike at the 80 calls was there last week. Maybe it was open not so long ago. Well, downward, accordingly, for December, the path to the 60s is already open. So overall, they might well be able to hold 80, but for the birds, the most important thing, in principle, is to hold it until expiration, meaning that breaches are quite possible. So that's what we have in terms of open interest. Now, regarding the holiday next week, it turns out we don't have any major ones, so overall, there are some that aren't significant for crypto or for their country. Yes, there's some kind of holiday here accordingly, and so it turns out that it won't have much of an impact. So, and accordingly, fear and greed. As for fear and greed overall, we are in neutral territory. By the way, that's a good thing. Neutral territory is usually the best for movements. That is, when the market doesn't have a clear understanding of what and where, overall the market can grow quite well. So let's take another look at the Saylor website. And from the Saylor website, you can see that overall, the ratio of calls has almost reached 0, and puts as well. That is, just last week, there was still a bit. Puts were prevailing. Now this dominance has practically minimized, and as a result only 5% remains. So overall, you could say that they have evened out. And that's why, looking at both calls and puts, it's also clear that the market doesn't really understand yet where it should go and so on. Now we need to select the strikes. I think the best way is to choose the strikes using the backtester. We'll take the data from the weekly periods. So when insert them, so what we still see here is that basically a very significant number of these available options are currently sitting right in the highly favorable and critical green zone for us. That means it's still very profitable to buy, so let's see what we can pick, starting with calls. Alright, 81 is a bit expensive, so I'll start looking from at least 83. Here we have 83,420. Potential profit is 330%. With a drawdown, it comes out to 2.6. Actually, as I mentioned, this is not surprising because for the most part, the market has been rising. And in a regular market, naturally, calls look much more attractive. So it comes out to 330 for 2. They cost accordingly $420. So what about 84? 84. Here we have... Notice that the drawdown hardly decreases, which means the market is characterized by small upward price movements. So as it turns out, it is almost twice as cheap. And overall, our total profit practically doesn't change at all. So what's interesting here is that if you look purely at the numbers, 83 is more profitable. But since I want to get more X's if the market takes off, and right now I'm counting on a breakout, I'll go with the cheaper one. For example, if one is 430 and the other is 250, you can buy almost twice as many of the cheaper ones. And basically, if I'm expecting a move to, say, 88 to 89, then 88 to 84 will be more than enough for me. So I'll add it to the portfolio, and accordingly, let's look at the puts. There, the highest one we have is at 78, but it's also expensive, $500. So 164 for 8. The profit to drawdown ratio will be about 120. If we take 76, then it's 147 for 4 here. By the way, that's about 1 to... So once again, 78 is 165 to 8. That's 1 to 120. And here it's 76, 147 to 4 and 4. That's about 1 to... Well, not 40, but probably about 1 to 35. 4.4 to 30. That's 120, 132. Yeah, that's about 33. So overall, it's a bit more here. Is there any point in going further? 75 to 115. Here it's 148 to 4.4. 132 to 3. 132 to 3. Here, by the way, it's already 1 to 40. In general, of course, if you expect that the market might panic and drop sharply, then it turns out. the $115 ones would be preferable because you can buy twice as many of them. And probably I'll take those because overall options drop, or rather the market drops much faster than it rises. And if after 6 weeks we do end up dropping, I think these options could spike much more in the moment. And if that happens, there will be good opportunities to sell part of them and in principle lock in some profit. So I'll add them to the portfolio as well. So my call options are closer to the current price, and my put options accordingly are a bit further out, and together it comes out to $365. Alright, let's run a backtest. So I still really like the backtest results. It looks absolutely great. That is, at the moment, with current prices, pretty much any backtest involving buying will look great. In all likelihood, there's nothing to sell. So I think it won't show a single option of ours for sale. Although, look, it does show that you can sell some in-the-money puts, but for some reason, it doesn't show why. Because since the market for Bitcoin has mostly been bullish since 2020, selling options, accordingly, has been less attractive. You could sell a put like this, as the backtest shows, but overall, since around 2021, it's been better to just buy, so it's not that interesting. While Bitcoin was rising from 2020 to the first quarter of 2021, selling such puts was really great. So, accordingly, in 2022, this strategy also looked good in the regular market. Now, as the market has started to fall, these strategies have also gone down. It's not the most interesting trade, and most importantly, it won't help our position, because we need the puts to be further out of the money. That is, for example, if we buy at 75, and if we were shown now that, say, there is a 72 or 71 put option, a put option that is profitable to sell, then we could add it to the position and improve the overall backtest. But since there are only put options that are accordingly higher than our strike price, as for the options we've selected, they're not very interesting to us, so that's how we backtested it. Now, let us take a much closer look at exactly what we have in terms of risk. Here, our total risk is precisely $100. If the price goes down to those significantly lower levels, 70 will be somewhere around 11 times the initial return on investment. However, if it only goes to 87, the profit will be a bit less than that. When you look at the final numbers, it actually comes out to about 6 times there. So overall, I would say that it's a very solid and respectable result. I personally think that after such a long period of stagnation, a risk level of approximately 2% is quite acceptable for us. So, at the present moment, our total portfolio has experienced a slight dip and has now dropped down to 104,300, which represents about a 2% decrease, sitting somewhere around $2,000 in total. And accordingly, if we take a moment to estimate the scale, it turns out that this is actually about 4 times larger than our current position. Last time we looked at this, we took exactly 4.5 options, and the total risk involved was $1,800. Well, I think, by the way, that 1,800 is quite reasonable. It's just under 2%. Maybe, we could allow for a slight increase in risk. After all, and take 4.6. Well, basically, it came out to 1850. Yes, and this position suits me quite well. So, as I said, what we have is we're buying options pretty close, meaning that at the moment, if we take 75 down and accordingly 84 up, it turns out we only need to move about 4% up. So if we go up 4%, that will be, no, not 4, 5. So if we move up 5%, that will already be 84,300 for us. Downward, we need to move a bit more, so roughly about 5, well, around 6,000. 6,000 is accordingly around 8%, so 8% would be 6,400. And from the table, you can see that, for example, a 6% move upward is more than realistic. That is, a 6% move up happens every 14 weeks. So there hasn't been a maximum an upward movement, 14 weeks. Downward, of course, the series are a bit longer. That is, the maximum was 21 weeks without an 8% drop. Oh, actually, now that I think about it, the maximum was 29 weeks. But if we just take 8% up and down, as I said, the maximum period without an extreme was 11 weeks. And the maximum without a close was 15 weeks. Right now, honestly, if the market moves 8%, I probably won't even lock in most of it. Because if we, for example, set it to 11% here, let's say, then we'll see that the maximum period without an 11% move was 29 weeks. At the moment, we already have the 13th week underway accordingly. But by the way, it could still stay at 11% for a while, of course. So overall, it's somewhere around 10 to 11%. Basically, well, that's exactly where it should be closed. I think at around 9%, it's definitely necessary to at least partially close half of this position. So, friends, that's more or less how things stand. And with this position, I plan to move into next week. Friends, thank you for watching the video until the end. I'd appreciate it if you support it with a like, subscribe, or leave a comment. And remember, you can ask any questions about options in the comments to this video, or alternatively, subscribe to my channels. The link is in the description, and see you in the next video on Sunday. Also remember that this video is not an individual investment recommendation. Accordingly, all trades you make are at your own risk. As always, the only thing I recommend is not to exceed a risk of, well, a maximum of 4% per trade on weekly options. This was Roman Besedovsky with you. See you next time. Bye.